The Witan Investment Trust's half-year results for 2022 are out, and to discuss them, I'm joined by Witan Chief Executive Andrew Bell. Andrew, 2022 has been incredibly tough market conditions. Russia's invasion of Ukraine, inflation is picking up around the world. How did the Trust perform in the first half of the year?
Yeah, you're right. There hasn't been much consistency from almost 1 week to the next, let alone month to month, in terms of what the market's been concerned about. The bottom line is, over the 6-month period, we underperformed. We had a net asset value total return of minus 14.3% or so against our benchmark, which was minus 9.6, which all of the underperformance actually came in the first couple of months of the year or so, the lead up to and the immediate aftermath of the Russian invasion of Ukraine, when the markets moved from anticipating a sort of COVID reopening, slightly hopeful environment, to being faced with the threat of recession and an unforecastable political outlook. So we underperformed very heavily up to that point, and then in the following 3.5 months or so, we performed more or less in line, even though the falls in the market were greater. So we take a bit of encouragement from having outperformed during the most negative part of the market fall, but it doesn't really show up in the first half numbers, and so that's frustrating.
That's the backdrop, but if you look across the portfolio, were there specific drivers of performance for good and ill?
Yes, yeah. I think it's been very obviously in a period of falling markets. If you've got gearing, that's something of a headwind, and it was a headwind, particularly during the first couple of months of the year. But then we maintained, in fact, we added to our gearing into market dips, so that actually helped to improve our performance in the subsequent recoveries of markets, although there was no consistent trend during the first half. The problem was really very difficult to catch a break in terms of what part of the market you should have bought, because the tech stocks came under some pressure, and people thought, okay, this is a year for cyclicals. But then as soon as the war came along, people thought cyclicals are going to be no good because it's going to be a recession. The only area which really rewarded people in absolute and relative terms consistently throughout the 6 months was energy. And although we had some energy exposure, it's an area where active fund managers tend to be mistrustful, because you're buying something on the basis that it's a play on a price, the oil price or the gas price, over which they have no control. And so we were underrepresented in the one sector, really, which was the sole sector which carried the banner of positive performance in the first half.
You mentioned technology, and in the last few years, I think it's fair to say a small number of very large tech stocks have driven the market. Certainly this year, that seems to have been reversed. Why is that? And how are you playing it at Witan? Is it a temporary thing? Do you have to take a view on whether?
We don't have to take a view, no. But I think one of the most obvious reason why there was a big setback, in which the setbacks in the market were concentrated more heavily in the technology sector, and they were most concentrated in the parts of the technology sector which aren't profitable. But even the FANGs, as we call them, which are profitable companies, I just became overrated. I think by most people's judgment, there was too much optimism there. And in the unprofitable tech stocks, some of which will be the FANGs of the future, there was an awful lot of hope built into the long-term prospects of a company which might hit its stride in 5 or 10 years' time. The problem is, when interest rates start rising, the price of long-term hope goes up. And so the discount rate applied to the future value of these companies rose. And really, when there's no immediate profit to rate a company on, where's the floor for the price? At least with Google, if it goes from 35 times to 20 times, you can form a view as to when you want to buy it. And some of although we're not by any means a growth specialist, we do have a couple of growth managers who had significant exposure to the unprofitable tech companies. So although they were the smallest allocations among our global managers, the hit to that part of the market was quite painful to our overall performance.
Given this period of uncertainty that we're seeing in global markets and the economy, are you seeing any change in the way the underlying managers you invest with, how they're looking at stocks?
There have been some changes at the margin. I mean, the growth managers, for example, towards the end of last year, were showing some signs of allergy to chasing ratings. So they were beginning to buy luxury goods stocks rather than, sort of long-term internet marketplace stocks. And during January, when the market's view on interest rates changed dramatically, suddenly they're going up a lot rather than they're not going up at all. There was some switching out of the longer-term unprofitables into the sort of Microsofts of this world, which are if slightly more defensive technology play. Several of the non-growth managers have increased their exposure to energy, not, I think, taking a positive long-term view of fossil fuel producers, but it's a bit of an insurance policy because energy was a big component in the inflation we've already seen. It's also the biggest risk to inflation going up a lot more, because not just in the UK, but globally, if oil prices in some sort of crisis were to double from here. So having some exposure to energy stocks was an insurance policy against the more normal circumstances which you're hoping for the rest of your portfolio proving misplaced.
Andrew, you hire your underlying managers to do very specific jobs with the funds that you entrust them with. Given this period of change we're going through, how do you make sure that they're staying true to their philosophy, their beliefs? They're not getting too flexible, if you like.
Well, no flexibility is obviously a hazard in a changing world, and as you say, if you're pushed off your sources of strength and value added too easily, then you're effectively like a supermarket trolley, as the phrase has been over the last year. Actually, most of the managers didn't change radically, because what effectively the principles they're trying to pursue are to find honestly and well-managed companies doing something useful and enduring, and with the finances to make sure that when misfortune comes along, they're not going to be forced into an emergency refinancing or become distressed. So those principles still hold true. It's just that the external influences change. Hence the people who were otherwise suspicious about fossil fuel companies being prepared to buy some oil companies because that was right in the circumstances to balance the risks within the portfolio. There was probably a little bit more emphasis on balance sheet risk in this environment, partly because there was a sharp and rather unforecastable rise in the risks of recession. It's an open question whether it comes about or not, but nonetheless, it was the growth outlook became more troubled. And because interest rates were rising against a background of dramatically higher 30-year highs in inflation rates. So people suddenly had to contend with the risk that companies with an amount of debt that they could readily finance at 2 or 3%, if they suddenly find that they're having to pay the bank 6 or 7, that some companies will, some companies won't be able to cope with that.
Turning to the portfolio, the bulk of it, the core of it is in global equities, but you've got a specialist portfolio that you've been building up over the last few years. Can you give us an update on what you're doing with that portfolio? What are some of the key themes you're focused on?
Yes, it's the guideline is it's up to around about 25% of our overall portfolio, and the purpose is that the other 75 is delegated to managers who are going to do most of the heavy lift of finding attractive stocks within our benchmark indices, and the 25 is to give us the opportunity to invest in either specific themes or specialist managers, areas which might intermittently become attractive, and it's roughly divided into 2 areas. Around half at the moment is invested with an emerging market manager and a specialist climate change manager, both of which have actually performed quite well during the period relative to our overall performance. And those are themes which emerging markets obviously rather more tactical, whereas climate change we see as an enduring long-term thing, and we actually increased our exposure towards the end of the period to our climate change fund. The other half invests in a range of specialist investment companies in areas such as listed private equity, sometimes commercial property. We have a commodities fund in there. We also added to our biotech exposure with a specialist ETF because biotech's been a terribly performing sector, and yet some of the most promising medical developments that are happening in the smallest companies in that area. And within that, we had a couple of very strong performers in that portfolio. There was a real estate fund. We took a little bit of profit out of that when it had a real surge in the spring. And the BlackRock World Mining Fund, we reduced our exposure again when it had an enormous rally in the first few months of the year. They're both areas that we maintain exposure to. The area which did less well in share price terms was the listed private equity area, because when the markets become more risk averse, they're a bit more nervous about what the next asset value these companies declare is going to be. They are leveraged plays in some ways, but actually the companies we own have declared very, very decent NAV performances. So it's all been down to the discount widening.
Turning to the income side of the equation, I think revenue per share of the trust did come under a bit of pressure on the back of COVID as underlying companies cut their dividends. How are dividends recovering now, and what is Witan's dividend policy?
Yes, 2020 was the biggest wake-up call for revenue investors in probably half a century. And we also moved to a lower yielding benchmark at the same time. But since then, we had a decent recovery in our earnings during 2021. I think they increased by just under 20%. The first half of this year, our revenue earnings were up 39% relative to the first half of last year, which was dramatically stronger than we would have expected. And when we decided at the end of 2020, we reviewed our dividend policy because we'd been paying growing dividends for 45 years or so. And when your earnings halve, you think, well, is this sustainable? And we decided, yes, it was sustainable, partly because we've got revenue reserves that we could use to smooth that dip in earnings, and partly because when we modelled it, we thought that on pretty plausible assumptions, we could see dividends being recovered within 4 or 5 years. And since then, the outcomes for dividends have been much stronger than we would have expected. So on the same assumptions, we're going to find our dividends covered sooner than that. And our policy is that we aim to grow the dividend in real terms over time. And we've grown it for the last 47 consecutive years. There'll probably be 1 or 2 years, last year and conceivably this year, but that's subject to future decision, when our dividend growth will fall short of inflation numbers. But we think it's not an idle hope that we will be able to continue delivering growing real dividends.
Volatility and uncertainty have been real themes of our discussion the last 5 minutes or so. Given that backdrop, Andrew, are you tempted to change the approach on Witan?
I think you've got to try and strike a balance between two risks. One is overreacting to short-term influences. If you're driving along the road, you have to keep a perspective on the distant road ahead. And if you concentrate on the flies hitting the windscreen, you can't do that. So you have to keep a sense of direction based upon whatever your fundamental principles are, and avoid being pushed around by short-term volatility. At the same time, you can't ignore reality. You have to avoid underreacting to things. For example, if you're a hedgehog, it's a great trick to be able to roll yourself up if there's a fox around. But if there's a flood, that's not going to work. So you have to be willing to adapt while not overreacting to short-term influences. And so really, in summary, right now the market is very preoccupied with inflation and with the attendant risk of interest rates going up, and that builds a lot of pressure on individuals and on companies. People are quite gloomy about the economic outlook. As we go through the next 6 or 12 months, although there are clearly risks, some of those risks will get worse in the short term, but medium term, it looks like an awful lot is already discounted. And we believe that there's value in these markets, although there are some areas better value than others. And that when people can shift their focus from the peak of inflation and how far interest rates are going up towards the medium term, there are some really quite positive trends for demand in economies, perhaps less positively defense spending, but that's going to be certainly a big driver of industrial growth. And on the more positive for humanity side, investing to try and take the sting out of or mitigate the effects of climate change. There's also many economies are spending a lot of money on infrastructure growth. And those are all areas which are going to be good for jobs, good for companies and profitability. And at the moment, nobody's interested. And we think that it pays to bet on human ingenuity and on positive economic growth in the medium term, and to keep that gleam in mind when the clouds are gloomier. Remember that there's a sunshine period at the end.
We have to leave it there. Andrew Bell, thank you for joining us.
Thank you.